How's it going today, guys? Welcome back to the channel. Hope you're having a great day so far. So in this video, I'm going to be doing a follow-up to a video I did, I believe it was about a week and a half ago, talking about don't put your money in the bank, why you shouldn't be putting your money in the bank. And that video pretty much went viral for this niche that I'm in here. So I didn't get millions of views, but I know we're up over 100,000 views on that video. So for those of you who found that video and found my channel, welcome to my channel. I'm glad to have you guys here. But I honestly did kind of a disservice in that video. First of all, I thought that was going to be a quick 5 to 10 minute video. It ended up being like almost 20 minutes and I still left a lot of details out. And so I wanted to do this follow-up video here and talk about what are the other options out there as far as putting your money in something outside of a traditional bank account, because there are other options aside from the option that I pointed you guys towards, which was investing in short-term bonds, particularly treasury bonds. And so a lot of people had some very valid questions from that video, so I'm hoping to answer that in this video, talking about what are some of the best options out there for your short-term cash. All right, so starting off here with option number one, we have online bank accounts. And the most popular one out there is Ally Bank. Ally Bank is offering you a 2% yield on your savings account, which is a very attractive yield for a bank account. And so I want to talk about why is it that Ally Bank is able to pay 2%, meanwhile your traditional bank, your traditional brick and mortar bank is paying you about 0.06% right now. Well, reason number one for that is the fact that online banks are handling everything online. They do not have any branch locations. They do not have any ATMs that they have to maintain. Everything is handled online, and as a result, there is some massive savings involved with that. But there's also pros and cons to that. Some people go to the bank to get checks printed, or they go to the bank to socialize. Seriously, I mean, literally, I go into my bank sometimes and there's just people hanging around there. It's like social hour for them, but whatever. Some people, that's where they go to socialize. So there are all these other perks involved with having, a physical bank, and for some people, it might be worth that very small yield that you're getting from that bank account. So online banks are typically able to offer lower fees and higher rates simply due to the fact that everything is handled online. They are FDIC insured, just like a regular bank account. They are also offering you pretty much 3 business day access to your funds, and you're going to be taxed at ordinary income. The reason why I'm telling you guys that is because option number 4 over here, what we discussed in that video, you're going to have a slight tax advantage with that. So the interest paid to you is taxed as ordinary income, and if you're kind of confused by that, if you've never gotten a tax form from your bank, it's because unless your interest income exceeds $10 for the year, they're not required to send you that form. You are still supposed to report that income, but if you receive more than $10 of interest income from your bank, they're going to be sending you that tax form. So that is pretty much what Ally Bank and other online banks offer. There are a number of different ones, and Graham Stephan did a really good video talking about them. So I'm going to link to his video in the description below if you're looking to learn more about these online bank accounts. All right, option number 2, where most people stick their money, where is pretty much the worst place for your money aside from putting it under your mattress, is your traditional bank account. But again, a lot of people do this for convenience. They want to be able to go into the branch. They want to be able to get access to their money through ATMs. They have checks all the time that they want to cash, or maybe they're operating a cash business where they have to get cash into their bank. There's a lot of reasons why you would want to have a traditional bank account. But a lot of millennials in particular, they're not using these services. They're doing mobile deposit on their phone. They pretty much are like allergic to cash. Personally, I never have any cash. So if you're one of these people, then an online bank might make sense for you. But if you still have a lot of cash that you're using and you like going into the bank, this makes sense for you. You have FDIC insurance, the same 3-day hold on, transfers and funds like that. And it's going to be taxed as ordinary income, but most people are not going to make, more than that $10 threshold where their bank is going to be, sending you that form reporting that income to you and the IRS. All right, option number 3 that kind of got everyone started on this whole conversation is Robinhood and this 3% checking account that pretty much there's no trace of anywhere on the internet now. If you go on their website now, it simply says Robinhood Cash Management coming soon, and there are absolutely no details. And that is because of the fact that there was a lot of backlash after Robinhood announced that they were going to be offering this 3% checking account because they claimed it would be SIPC insured. So FDIC is what insures bank accounts, SIPC insures brokerage accounts, and they were claiming that they were going to have SIPC insurance of your money because they were a brokerage account. But there was one loophole or one thing they overlooked, and that is the fact that SIPC protects your money for potential investments. So the cash that you have that's going to be invested and also your investments. They're not protecting you from losses, but they're protecting you in case, the brokerage company goes insolvent, they lose access to your stocks or bonds or securities, and they lose your money. You have a certain amount of protection. But the thing is, this money that you're putting in Robinhood is very clearly not being used for the purpose of buying securities, and so SIPC said, we're not insuring it. So basically Robinhood realized that if they're not going to be insured, nobody's going to be putting their money into this fintech startup company that's very, very new with a very limited track record. You're not going to be putting a lot of money into this when you have no insurance. And so they've pretty much taken massive steps backwards on this and removed all traces of that 3%. All right, option number 4, what I discussed in that video is investing in short-term bonds. And what I told you guys about was a platform called Betterment that offers a feature called Smart Saver. And if you guys are interested in checking this out, I have a link for it in the description below. It is an affiliate link. You guys don't have to use it, but understand that if you do, it helps me out and helps to support my channel. But Smart Saver is basically investing your money. It's taking the excess cash from your bank account and putting it into very low risk short-term bonds. 80% of your money goes into a short-term treasury bond fund, and the remaining 20% goes into another short-term bond fund that is composed of short-term investment grade corporate bonds. And so basically by doing that, what they are able to get you right now after fees is a yield of 2.09%. So it's slightly better than what is being offered by Ally Bank. It's a hell of a lot better than what you're being offered at your traditional bank. And yes, Robinhood is offering you more than this, but this is not quite a reality yet. So this might be a good option for people looking to protect the buying power of their money. But there are a couple of things that you have to know. First of all, you are not FDIC insured. You are SIPC insured, meaning you are not insured against any losses incurred with that investment. But if for some reason, Betterment lost your investments or lost the cash that you were going to invest, you are insured up until a certain dollar amount. Beyond that, the other difference here between these is that the transfer time for moving money between your account is 4 to 5 days, a little bit longer than these other options out there. But there is one huge advantage here with Smart Saver, and that is the fact that 80% of your money in Smart Saver is being invested in short-term U.S. Treasury bonds. And U.S. Treasury bonds are exempt from state and local taxes, whereas any kind of interest income from an online bank or a traditional bank is going to be taxed as ordinary income. So the returns that you're getting from Smart Saver are going to be taxed just on a federal level, not on a state or local level, resulting in tax savings here. And maybe if you have a very small amount of money, this isn't a lot to you, but if you have, tens of thousands or hundreds of thousands of dollars in cash, that could actually start to make a difference. And then beyond that, the other huge difference here between investing in Smart Saver, investing in short-term bonds versus leaving your money in the bank is the fact that banks are not going to keep up with the rising interest rate environment that we are in now. We just saw our 4th rate hike for the year, and what you're going to find is that you're going to immediately see a higher return here with Smart Saver because you are owning short-term bonds. And as soon as you see interest rates go up, short-term bond rates are going to go up as well, meaning that as interest rates are rising, your yield is going to increase. Banks, on the other hand, set their own rates. Now we know that in 2017, I believe banks were paying 0.05%, and on average now that's been raised to 0.06. So there's a little bit of movement there, but not nearly as much as is needed. And while Ally Bank is paying 2% and it's FDIC insured, while that is great, there's no guarantee they're going to increase that to 2.25 or 2.5% as interest rates rise. We certainly hope they do, but banks set their own rates at the end of the day, and in a rising interest rate environment, you could potentially end up getting left behind as rates are rising. So that is the big difference here. If you want complete security, you go FDIC. And if you're a young person who doesn't necessarily need to go into a bank, online banks are a fantastic option. If you want to go to the bank to socialize and get checks and deposit cash, then you got to keep your bank account. Maybe you put your slush or your extra into an online bank account. If you're comfortable with the very small amount of risk involved with short-term bonds, and just so you guys know, Treasury bonds are considered to be the safest investment out there outside of bank-insured investments. If you're comfortable with that very small amount of risk, there are many advantages to investing in short-term bonds, and it's pretty much guaranteed protection of your buying power because it's going to be increasing as rates increase as well. But anyways, guys, I just wanted to go over this and cover the main differences between traditional bank accounts, online bank accounts, and then this Smart Saver being offered by Betterment, just because I feel like I really didn't cover it that well in that original video. But anyways, guys, that's all I got for this video. I have a link down below if you guys want to check out Smart Saver. I also have some other resources I'll include as well. But thank you guys so much for watching, and I will see you in the next video.